Nvidia, the chip maker, recently hit a $5 trillion market capitalization. That valuation is larger than the GDP of every country in the world except for the US and China. OpenAI, a subscription service that famously still loses money on nearly every query it answers, has been valued at over $500 billion. The scale of this investment, the cash being thrown at this sector, is unprecedented. Sam Altman himself, the CEO, admitted it publicly in 2025. We are in a bubble. The stock market today is hitting extremes not seen since the peak of the year 2000. Look closely. Roughly 80% of the S&P 500's gains come from just a handful of AI-related megacaps. This is not just technological enthusiasm, it's a math problem that doesn't add up. The question is not if the valuation is a delusion, but whether this delusion is necessary. Is this the final, destructive mania before a total market crash? Or is this a useful industrial bubble that is accelerating the future of human development? That's the core conflict. We need to look past the hype and examine the 4 financial facts that prove the current AI valuation is unsustainable, and why a crash may actually be a good thing. Kindly remember to subscribe to the channel to get the unfiltered truth on tech and finance. The entire AI economic system is currently running on a dangerously incestuous financing loop. Follow the money. Microsoft, Amazon, and Alphabet are all in an arms race. They invest billions into AI research labs like OpenAI and Anthropic, or into their own internal research. Where does that cash immediately go? It flows directly to Nvidia to buy the necessary high-margin chips, or straight back to Microsoft and Amazon to rent cloud compute time on their respective platforms. We are watching a self-sustaining financial cycle, where big tech is essentially selling massively expensive hardware and services to itself, or to the startups it funds. This creates massive reported revenue growth, but it's an illusion of organic external demand. It's vendor financing at the highest level. The Bank of England and other financial bodies have flagged this circular financing as a major weakness, calling it a concentration risk. When capital is flowing in a closed circuit, it artificially inflates every valuation it touches. Nvidia, for instance, controlling over 80% of the market for these specialized chips, creates an extreme risk. If one player stumbles, if Microsoft slows its investment, or if a competing chip gains ground, the dominoes will fall fast throughout the entire sector. We must ask, if you subtract the cash cycling among the big tech companies, what is the real, external, profitable revenue being generated? Uncertain. That concentration is a systemic vulnerability. The core cost of this AI revolution is not the software. It's the unprecedented physical construction of data centers. The global AI data center capital expenditures are set to surge past $400 billion in 2025 alone. McKinsey and other analysts project that meeting compute demand will require building infrastructure worth between $5 to $7 trillion worldwide by 2030. This is not being funded purely from the cash flows of the megacaps, despite what some analysts claim. While the giants are profitable, they are also spending so aggressively that they are increasingly turning to debt. Tech giants like Meta and Oracle issued tens of billions of dollars in bonds and loans in late 2025 to fund this expansion, with overall U.S. secured debt tied to data centers spiking by over 112% year-on-year. This is leverage. This debt is the great risk. Data centers are long-duration assets requiring 10 to 15 years for optimal returns. But the investors funding them have short-term expectations. If the AI market corrects, that debt becomes the source of a systemic problem. Furthermore, we are aggressively leveraging our economic future to build assets today whose long-term value is based entirely on the assumption that AI model efficiency will not rapidly improve. If models become smaller and smarter, the trillion-dollar infrastructure we are building becomes an obsolete stranded asset. The market is valuing companies based on boundless potential, not current profit. This is the classic signal of speculative mania. Companies are spending billions on AI tools and licenses, but the majority are not yet redesigning their core workflows to capture the value. A sobering MIT-linked study reported that nearly 95% of generative AI pilots fail to generate a meaningful positive business impact beyond early experimentation. This creates a huge gap between the hype, driving the valuations and the demonstrated productivity gains. This valuation is not based on cash flow, it's based on pure belief. If enterprises cannot fundamentally change their operations to leverage AI, those productivity gains and the promised future revenue will not materialize. The market will be forced to re-rate these stocks violently. The consensus earnings expectations are already extremely high, making these stocks vulnerable to the smallest disappointment. When the growth stops accelerating, the valuations collapse. We have seen this movie before. In the late 1990s, the internet was correctly identified as world-changing, but companies were still ridiculously overvalued. The Nasdaq lost 75% of its value from 2000 to 2002. The bull case claims today is different because the megacaps are profitable and have strong balance sheets. That is true. But the risk is in the highly speculative tier, the OpenAIs, Anthropics, and thousands of application layer startups that have valuations based on accessing a foundation model, not owning proprietary technology. The dot-com crash wasn't just about bad companies, it was about overcapacity. Companies laid vast amounts of fiber optic cable that remained dark, unused for years. Today, we face a similar risk with compute capacity. If AI models become dramatically more efficient, or if the industry shifts quickly from the expensive training phase to the less demanding inference phase, the data centers we are debt financing today could become the next generation of stranded assets. The technology will survive, but the valuations will not. So, if the valuations are a bubble, what happens next? This is where the forward-thinking analysis of economic history is vital. According to the work of economist Carlota Perez, technological revolutions go through a required period of speculative frenzy, the installation phase. The bubble, in this view, is actually a necessary evil. The mania forces financial capital to fund the essential physical build-out, the GPUs, the fiber, the hundreds of new power grids. That is simply too expensive and too risky for rational investors to fund in a calm market. It takes the speculative frenzy to lay the tracks for the future. The bubble's role is not to create a stable economy. Its role is to fund the global infrastructure. The inevitable crash is simply the turning point, the required event before the true deployment period of real productivity gains can begin. The inevitable burst will not be a sudden, destructive global crash because, as pointed out, AI is already woven too tightly into sovereign wealth funds and national defense strategies. Instead, expect a series of smaller, violent pops. The main correction will fall on the highly leveraged frontier model labs and the thousands of venture-funded AI application startups. They will face mass consolidation and collapse. Nvidia and the hyperscalers will suffer valuation compression but survive because the physical assets they own, the data centers and proprietary chips, will still be needed. The ultimate survivors will be the companies that didn't just buy the AI tools, but fundamentally re-engineered their business models to capture real productivity gains. The debate is settled. The valuations are an unsustainable bubble. The real question for your money, your career, and the future of technology is, what is the necessary destruction that is required to finally move from the hype of the installation phase to the real productivity of the deployment period? That's the unfiltered truth. The cost of entry for the AI revolution is a future market correction. Prepare accordingly. If you want more skeptical, honest analysis on the tech market that cuts through the noise, hit that subscribe button.